Okay, so welcome to the January 26th housing market update, where we're going to do a recap of 2025 and take a look at all the key takeaways from 2025. So let's jump right in and check out the slide deck that I've cooked up for you. It's 12 months of doing the housing market update in 2025, and a lot of important things have happened in the last 12 months. The most notable thing is affordability. We've seen a slight improvement of affordability, but it's still the number one slide on this deck because it's still the most impactful thing happening in the housing market update right now. In other words, a lot of people still can't afford to buy a home. So affordability has remained at near historic lows. Slight improvement due to flat pricing, right? I mean, how do you make homes affordable? Well, you either got to lower rates or you got to bring prices down. One of those two things have got to happen. So the rates did more help for affordability than pricing did. And but it's like this quote says here, 2025 didn't fix it, but it kind of stopped it from getting worse. So that's a good thing. Here's the chart on affordability. That shows you the orange is basically unaffordable, the blue is more affordable, and you can see that ever since 2021 it just shot up. But you can see that from 24 to 25 there's a slight decrease, so it is getting a little bit better, but not a whole lot. Mortgage rates, they ruled the market. Rates fluctuated between the low sixes and the sevens. Rates dipped temporarily, which boosted activity. And that's what basically happened. Every time the rates kind of came down, the market got a little bit busier and busier. Here's a look at the last 5 years of the 30-year fixed rate. You can see on the screen here. This tells the story really of the inventory problem, and a lot of issues is that rates were so low, they were hovering around 3, and then boom, they shot up right into the 7s and the 6s, and we've been bouncing. And then, as we learned this year from a lot of very smart economists and whatnot, everybody's kind of looking for this blue line. Instead of hovering between 6 and 7, we want to see it hover between 5 and 6. And a lot of very smart people think that if the rates start to hover in this area once again, the market will kind of normalize and take off once again in terms of the number of transactions. So that's kind of what we're looking for, the 5 to 6 range instead of the 6 to 7 range. Okay, so inventory did rise, but there's still a shortage. We're looking for, 2025 on a national level, inventory was up 10 to 25% year over year, but there's still a shortfall, 3 to 4 million homes. The lock-in effect kept many sellers in place. Lock-in effect being, the rates shot up, so now sellers can't buy something and get a rate that is commensurate to what they have, so they're kind of locked in place to their current mortgage. And home prices flattened. Okay, that's the right word for it. It flattened. It's still increasing, but not as a large enough variance as previous years. So national appreciation was under 1% year over year. Many markets saw slight declines, and regional variation increased in terms of some regions having success and some having declines in terms of price. In the Northeast, and specifically in our areas, North Jersey, Hudson Valley area, prices have continued to increase year over year. Here's a look back at a slide that I put together a couple months ago. This is from an article with the Wall Street Journal that shows average price cuts, right? And the point here is to all the sellers out there is that the longer you wait, the more likely you're going to have to decrease your price at a larger amount. So the point is you don't want to wait too long to drop your price. And ideally, you start out at the right price from the get-go. So it's all that more important to listen to your realtor right now, really dive into the data that they're showing you so that you can make your own decision on what you really think it's worth, and make sure that you price it aggressively because the market is changing, okay? It has changed already. 2025 brought that change. Sales volume still stayed low. Existing home sales remained near multi-decade lows. That didn't change much in 2025. But again, some local markets did outperform other markets. So a lot of it is becoming regionalized right now. In our area, again, North Jersey, Hudson Valley area, we still saw a very low amount of transactions, historically speaking. We didn't see any necessarily major comeback in terms of transactions. Here's a look at the national sales. The projection was basically to remain flat. We're not going to know the final numbers from 2025, probably for another couple of months. There's quite a bit of lag time with national numbers, but they'll be out soon. And when they are, we'll let you know in the upcoming housing market updates. But that's a good look at national numbers where things are. Buyers, they gained leverage in 2025. They certainly have more negotiating power. If you think back 12 months from where we were and where we are, and you're a realtor with boots on the ground, like doing deals, you can definitely you can understand that, right? Because now you're, instead of having to, in many cases, bid over the asking price, sometimes there's actually negotiations now, and inspections are a thing again, right? Buyers aren't having to pass on inspections, which is a really good thing. It's good for people to have their time for due diligence with a major asset that they're buying. Price cuts peaked in October, meaning the number of homes that were coming down in price, and homes were taking longer to sell. So all that, boded well for the buyer side of the transactions. Regional divergence was defined in 2025. The Sun Belt, it really cooled off. There's some markets down there that kind of tanked, quite frankly. I read a good article the other day about condos in Florida are really taking a big hit. Things are really slow in many condominium complexes throughout Florida. So local conditions have really mattered much more than national averages for the first time in a while. And that's what you tend to see in a changing market, is that, it's a huge country, a lot of large, vast areas of geography and population movement and whatnot. So each area kind of is slightly different. But when you have an overall changing market, it's just some markets haven't really been affected yet, and some are going to be affected more than others. So there's no question that 2025 was a year of great change in the housing market. Here's a look, kind of like a heat map. You can see the darker the gold/beige color, the larger the decrease in national home prices. Okay. The deeper the blue, the higher the average home price grew from 24 to 25. But you can see there's not a lot of dark blue. In previous years, a lot of the map was dark blue. So it's cooling off is what's happening, right? The price increases are not everywhere. And in many cases, price decreases are happening. But you can see up here where we operate in North Jersey and the Hudson Valley, still pretty much all blue. And that's consistent with the numbers we've been tracking. So the outlook for 2026, gradual normalization expected, which is, what most experts agree on at this point. That's been my gut reaction now for the last, 6 to 12 months, that I don't see 2026 necessarily roaring back. I think it's about normalization. I think things are just kind of grinding to a normal level right now. That means that more inventory is going to be expected, right? We see this. Inventory is going to be, anywhere from 10 to 15% increase nationwide. And rates hopefully will likely drift towards the sixes. So that's the outlook for 2026. Normalization, rates drifting more towards 6.0 level, maybe a little bit under if we're lucky, and inventory expected to rise. Okay, so with that said, why don't we bring in Amy Green, mortgage loan officer extraordinaire, to talk a little bit more about the mortgage market. Amy, are you there?
Okay, so again, good morning, everyone. It's a pleasure to be here with you today. I wanted to quickly discuss what has happened since 12/9/25 at our last sales meeting, right? So good news, rates have slightly decreased. On 12/8, the 30-year mortgage was floating around 6.36. As of close of business yesterday, it's now floating right at 6%. Another good thing is CPI inflation report data that was released this morning. was actually slightly lower than expected. That is good news because in general, higher inflation coincides with higher rates and vice versa. So where are we at? 30-year fixed, right around 6. As you can see, this chart here, all good interest rates. We're in a really good position here for 2026. Here's what happened in the past month. As you can see, we started here and it came down a bit. Right here is where Trump made that announcement about putting billions in and having Fannie and Freddie purchase mortgage-backed securities. So that was that right there. Then for over the past year is we're in a much better position, as you can see. I mean, it was floating even above 7 a year ago. Now we're right at 6. Monthly impact, just to give you guys an example. So if you're looking at 6.36 on a $350,000 mortgage loan amount, the difference from last month to this month at the sales meeting, you're looking at a difference of about $79 a month from 6.36 to 6.01. Key takeaways and what's next. Federal Reserve outlook. Basically, they're predicting modest rate cuts this year. It's going to depend on the incoming data, the labor market, a whole bunch of other things. As you know, there's a lot of geopolitical winds in the air right now, so there's a lot of uncertainty there. However, I would say in summary, rates may not be where they were a few years ago, but they're still historically normal. Buyers who understand their options and have the green team are still winning in this market.
No doubt. Good stuff, Aim. Thanks for that information. And I would agree. I think the one big takeaway for the last couple of years is that, yeah, rates shot up, but they're still historically very low. When you look at the 30-year fixed average on an all-time basis, the rates are as good as they've ever been in any historical period, minus that little, 3 to 5 year blip where the rates got as low as 3% on a 30-year fix. So